What do we mean by investor? Throughout this tape, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis, we attempted a precise formulation of the difference between the two, as follows. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 through 1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our listeners from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys, or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1949, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave as their reason, not safe, a gamble, and about half the reason, not familiar with. It is indeed ironical, though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky at a time when they were selling on a most attractive basis and due soon to begin their greatest advance in history. Conversely, the very fact that they had advanced to what were undoubtedly dangerous levels, as judged by past experience, later transformed them into investments and the entire stock-buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the listener will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon Pure investment policy comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss large enough to be disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits and to be prepared financially and psychologically for adverse results that may be of short or long duration. Outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations, there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing, but there are many ways in which speculation may be unintelligent. Of these, the foremost are: 1. Speculating when you think you're investing. 2. Speculating seriously instead of as a pastime when you lack proper knowledge and skill for it. And 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. and everyone who buys a so-called hot common stock issue or makes a purchase in any way similar thereto is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you're ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. We have already defined the defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow, and what return can he expect under average normal conditions, if such conditions really exist? In 1965, we recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component, that his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%.